Hi everybody, I'm Nicolai Tangen, the CEO of the Norwegian Sovereign Wealth Fund, and today I'm thrilled to have Brian Moynihan with us. Brian is the chairman and CEO of Bank of America, one of the world's largest financial institutions, and we own 1.5% of this great company. Brian has led the bank for 15 years, steering it through the aftermath of the financial crisis and transformed it into a digital powerhouse. So Brian, wonderful to have you here.
It's great to be here, and thank you for your support to our company, and look forward to a great session with you today.
Wonderful. Brian, you sit on the top of one of the world's largest banks. What's happening in the world?
Well, I think there's a little bit of bifurcation between what's happening in various segments of the world, but you can add it all up to the world. But I think largely what's being driven now is the United States change in its policy towards from an economic basis, leave aside a geopolitical basis, but on an economic basis, a major change going on is the U.S. has changed to with respect to four policies: trade tariff type policies, immigration policies. This is more domestic in the U.S., but the taxation, budget policy, and then deregulation. And you're seeing that play out in the U.S. And obviously, as the world's largest economy and the biggest trading partner with most countries, you're seeing that impact around the world as we go through that change in the set of policies with the new Trump administration.
So when you try to get a feel for where the world is moving, what are the indicators you are looking at?
So when you look around the world, you look at a lot of indicators. But again, bring our additional perspective on the U.S. We have a great research team, which your firm and others benefit by. That's a major investment, $500 million a year annual investment in research, and they have the world growing a little bit less than 3% for the next for this year. They have the world in terms of slowing down a little bit based on all the discussions we could have about trade and tariff policy. But when you look at the U.S., what we look at is not only what that research team tells us, which the U.S. will grow at 1% fourth quarter of 25 versus 24, to give you a sense annualized. When they give us that kind of projection, no recession, Fed's not going to cut rates, then we look at our actual customer data. And if you look at our customer data, we have great insight in the American consumer with 70 million American households we do business with. And we have great insight as the largest small business lender and middle market lender in the U.S. And those basically are telling you interesting things. That's what we look at. Then as broader indicators, I look at, and we can go into what they're telling us, but in broader indicators, I also look in the U.S. importantly about new claims for unemployment, continuing claims for unemployment, because frankly, that's a leading indicator of what businesses are really doing versus what they're saying.
Have you any private kind of secret indicators that you are particularly keen on that nobody else is really looking at?
Well, if you look at the American consumer, the discussion in the public domain was as consumer confidence factors went down after Liberation Day, April 2nd, and went back up, and all the back and forth. What we saw was no change in activity. So what are we talking about? The Bank of America consumers, 70 million of them, will send out of their accounts about $4.5 trillion this year into the economy. Year to date, it's almost $2 trillion because we're almost halfway through the year. If you look at that, it's up about 4.5% to 5% of the first part of 25 versus the first part of 24. If you look at the month of June, 4.5%. When you look at that amount of money going in the economy, that means the American consumer is participating heavily. When you look at their balances in their accounts, stable to growing, bouncing around, not the core consumer kind of stable, and the higher end consumer money went into the money market funds and other instruments earn interest, but the amount of cash they have is actually at record highs. And so they're in pretty good shape. Unemployment's 4.2% or whatever. The prospects for being unemployed are relatively low. So you put that aside, and then you have to balance that against what consumers are saying they're feeling, which is negative due to all the change and all the activity going on, meaning what's that mean? That means the tariff war. That means immigration. That means the reading that the economy is slowing down. And so what we see is the U.S. consumer is doing pretty well. We look at small, medium-sized businesses.
Brian, are you surprised that the consumer is doing so well, given the uncertainty?
No, not actually. Yeah, it comes down to, Nicola, the thing people miss is if the unemployment level is 4.1 in the U.S., which is 100 basis points below full employment, number one. And number two, wage growth is actually exceeding inflation in the aggregate across a period of time. Now, it ebbs and flows. Inflation came first and wage growth cut up to it, and now they're running more in sync. And then the remember, the U.S. consumer is a beneficiary of America's oil independence, and and that allows us to have a more balanced view when oil prices move around. But as oil prices came down, that's a big benefit to the American consumer because that just gives them more money to spend on something else. So I'm not surprised by it. Consumer credit is very strong. I'm not surprised by it at all. I can understand why other people are surprised by it, and that's because they're reading survey data, and that's what a consumer is on the couch. That's what they're telling you how they feel. I always say, look at what they're doing, not what they say they're feeling.
Why are they doing things differently than what they feel?
Because they have money and are employed, and they're pretty good at spending in America. And so that doesn't mean that won't stop. It just means that earlier this year, when everybody said the American consumer was out of was being broken by all this stuff. A year and a half ago, when the American consumer was supposed to be being broken by all this stuff, it never happened. They just kept spending and spending and spending. The stimulus payments that came through in 2021, people thought they were going to spend those down. They really didn't. The balancing accounts kept going, basically came down a little bit and then started growing again. And so it all comes down to the American economy is in okay shape. It's slowing down, and this is the trick. The trick will be balancing the impact of all this uncertainty around the business community, which gets hit by higher rates faster, especially small, medium-sized businesses, and also is confused about what the rules of the game are, that they need straightening out, tax policy and trade policy and immigration for those in certain industries. They need those workers. And if that doesn't clear up, then I could see people starting to actually really adjust their cost basis. And that would affect the American consumer because they'd be more worried about not having a job.
Are people with one political affiliation spending more than the people with the other political affiliation? I mean, are they feeling better about life?
We don't really see, that's a little hard for us to tell in our spending because we don't have that data for our people. But if you look at it more broadly in the surveys, you see that people who, in the Michigan survey, you can see in other surveys, you can see it's split by party affiliation in terms of their views of the future path of inflation, the future path of the economy. When it averages all out, because America's a 50-50 split by and large, it kind of averages each other out. So people, I think, overplay that because they're trying to make a political point. But I always say, don't look at what people say they're going to do. Look at what they're actually going to do. Whether it's a person on credit, are they going to pay it? It's not whether they say they're going to pay, it's whether they are paying. And a person on spending, it's not whether they say they're going to spend or not, it's what they're doing. And I think the consumers adjusted their spending around, but it's pretty good. Now, if you go to small, medium-sized businesses, this is where the Fed's rate structure really, really pinches. And people are writing more about that, but it took a while for people to understand that because large companies go to the markets and are not affected. A flat rate curve allows them to go out the curve and actually secure longer-term funds. The problem is a person who's running a $50 million, $100 million, $200 million revenue company, they're borrowing on lines of credit. And that base rate went from 25 basis points to 50 basis points up to 5 and now down to 4. That change is a huge change in the rate paid, and that slowed the businesses down in terms of making decisions. And you can see it that they aren't using the lines of credit at the level they were pre-pandemic, and sort of why not? The economy's growing well enough, the opportunity for demand fulfillment's out there, and it's because they're worried. So they aren't buying a piece of equipment, they're not making a change, and that's what we cite when we talk to the administration in the United States and say, you really need to settle this in. So that group of small and medium-sized businesses will get more aggressive. And as the Fed brings rate structure down, they'll feel better.
Is it the level of rates which is the main concern for the business clients, or is it other types of uncertainty, you think?
Well, if our survey of small business customers over the last year has shown different elements. First, it was rates and inflation because that was preoccupied. But and then it shifted back to workers. When I say back to workers, it was at that during the Great Resignation a couple of years ago in the United States. And what they're saying is the inability to get enough employees that can do the jobs that they have. That is being exacerbated by a lot of discussion you hear from them about the impact of inflation. And if you're in construction and all its related parts, you're a cement company, you're a delivery company, you're construction, actually building the buildings, the impact of the immigration policy is causing people not to show up. If you're in the hotel and leisure, farming, it's impacting you. And so I think in the broad base of employees, that's why you're hearing the administration saying we got to sort this out to make sure people know they're going to have the workers to be successful. And meaning agriculture and travel and entertainment and other types of industries. Because it's not that the activity is affecting a lot of them. It's the worry about the activity that's going to affect them that causes the workers not to come. So they went from being all about inflation, all about rates, to wait, I can't get the workers again, and can I get those workers? So everything's on their mind, but uncertainty about some of these topics is critical to them.
What about supply chain disruptions? Is that a main topic for your clients?
Yeah, it is. I mean, I fit that more in a tariff. And look, at the end of the day, we all learned something during COVID, which is the world's supply chains became extremely efficient. The problem was they weren't extremely resilient. And so as these tariffs go on, people are seeing sort of, I've got to be able to move my supply chain to places where maybe more favored as a trading partner to America if I'm bringing my goods into America. The real short-term thing is if I'm getting my goods from certain countries, if I have the same good manufactured in a country with tariffs of 10, 15% versus 30, 40%, and I'm going to supply to the same store to sell, guess what? Who's going to get sold at a lower price unless I just eat the tariff? So that going back to Liberation Day, that's what sent the shock to the system. The market went way down, the reaction to it. As it became clearer that they were going to get deals done and try to mitigate the overall size of the tariff, it happened. But the companies have two things they're thinking about supply chain. One is, what is the tariff architecture, trade architecture, non-tariff barrier architecture? And then secondly, what is the plain facts about the ability to have a supply chain that if something happens in a very specific place, it doesn't affect them. Mm-hmm. That we learned in COVID. Surgical masks, certain types of medical equipment, certain types of formularies. Leave aside the high tech and chips and everything. This is just basic stuff. You couldn't get it out of the country because of a particular area was going through a stress. That's not resiliency. And I think a lot of supply chain managers say, whoa. You're telling me I can't get this at any price? And they're saying yes. And they're saying, well, fix that. And that means the Vietnams and others, Mexicos and others will benefit by the supply chain sort of spreading out.
Moving topic a bit, many banks are closing their branches. You still seem to be a great believer in your branches. You got close to 4,000 of them. Why do you have a different view on branches than many other banks?
Well, we believe in high touch, high tech, and we follow the customer. And the customer shows us they like to do all of the above, right? And so whether they like the phone channel, they like the branch channel, they like the mobile channel and online channel, they like all the different ways to interface the company. And if you look at what's happened over time, we've gone from 6,000 branches to 3,800 branches today. We've added branches in new cities. Well, we still have gone down. We've gone from 100,000 people working in our consumer business to about 60,000 today. That's a massive reduction due to the digitization, customer behavior change. But between today and tomorrow, 24-hour period, 500,000, 350,000 people will come into our branches.
And who are these people? Are they mainly older people?
Everybody says would say it's older cohorts and stuff. It's just not true. It's a whole bunch of people. It's entrepreneurs who want to open their accounts. It's people coming in from investment advice. Largely what's big transformations, a lot of the routine activity. The strategy of branches starting 30 years ago was to basically take variability out, to make it a machine operation and make it very, very process oriented. And so we did that. That made them efficient, say, from 30 years ago to 20 years ago. Then we said, wait a second, a lot of these transactions can actually be done by the customer themselves, depositing a check. And that can be done through a mobile device. It can be done through the ATM. And suddenly we're able to move activity out. What that then left behind is what, Nicolai, is what really is important, which is in those 60,000 people today, we have probably twice the relationship capacity we did back then, because people tend to come in for more difficult issues. My mother died. I'm trying to figure out how to get the power of attorney so I can work with accounts. I need a mortgage loan. I'm just got my first bonus and I'm a younger person. I want to figure out how to invest it. And we have 2,500 FAs, we call them financial associates, in the branches that will help them start with Merrill Edge. So the complexity of the branches have changed to be much more relationship oriented. That's why the visit time is much more schedulable and understandable, as opposed to people coming in and doing routine transactions. That principle applies to all cohorts of age. There's no difference. If I'm my mother died and I'm 60, or my mother died and I'm 30, the issue is I got to figure out how to handle her accounts. So there's not as much distinction on those types of issues.
Brian, you've been pretty vocal when it comes to regulation of banks. And we love people who are vocal about, what they really believe in. So tell us, what is your take on bank regulations today?
If you look at it today, it's a classic case of the pendulum swung past the point, and also became sort of unreconcilable with each other. So if you go back to the financial crisis, Dodd-Frank in the United States, Basel III implementation on a global basis, all these things were meant to basically look at the core things that they thought were inadequate after the financial crisis. One of the core things that was inadequate that people forget about is a lot of companies that caused the stress in the financial crisis were not in the banks and system, were not regulated. First, you brought the companies in. Then it was capital, liquidity, range of activities of those companies, get them out of private equity and more principal activities and more into supporting clients like yourselves. Let you guys make the investments, let the private equity firms make the investments, don't compete against them. So it was range of activities. And then it went down the road, the models and how to build models and things like that. But what happened in that time frame, especially in the United States, is the way the rules kept changing is going back when we thought that the capital ratios in the banks of 7-8% would be adequate under the first after Dodd-Frank, and that was still, 25-30% increase probably from where people were to there. And people said that would be enough. We now went from 7-8% is adequate to 10-11% is adequate. And the risk in the industry is actually, quite frankly, probably come down on a relative basis during that time.
So if you look at all the regulations, where are the worst over regulations?
Well, first of all, in 2018, 19, the capital industry was sufficient. And it's gone up by 25%, and now they say it's sufficient. So I think what they have to do is get the capital rules set. They have to get Basel III implemented in the United States, but on a fair basis because we use a different standard. We got capital rules set. We got to get rid of some of the overlapping liquidity rules, which you've seen with this supplemental leverage ratio change. And we've got to get clearer about our ability to engage in more modern commerce. That's around the cyber stable coins and things like that, because it wasn't clear before. And then you got to let banks go out, and this isn't appropriate for Bank of America because we're not allowed. Let the mergers take place faster, because there's 4,000 banks in the United States, and there'll be changes in that system, and they got to not try to over-regulate that change for purposes that have nothing to do with the merger. So I think capital liquidity, merger rules, and then frankly, the consumer regulation stuff just got much more penalty-oriented, much more fine-oriented, much more beyond what consumers want, and got away from consumer choice. That's already swung back too. And there's high hopes of this administration we get it back to balance.
Anything which is not regulated enough? Like private, private credit, alternative providers of credit, and so on. Where do you see that?
So the principle is getting lost a little bit, Nicolai, in the last chunk of time here is the banking regulators being sort of what their charter is across the world, always only look at the banking system and then try to regulate the outside the banking system through the banking system, as opposed to saying, wait, if you make loans or take deposits, you're a bank. Whether you're a stablecoin provider or whether you're a private capital lender, you have to be regulated, a mortgage lender, et cetera. So the Consumer Bureau in the United States was meant to expand by activity, not by charter, as I call it. Activity meaning I make a mortgage loan, charter, I'm a bank versus non-bank. So it went to do that. That was a good thing. Unfortunately, it bollocksed up in different ways and got away from its core charter. But that's a good thing. That's not happening in the commercial space. In other words, there's lots of entrants in the system who are not regulated in the same way as other entrants. And what that means is you start to get into regulatory arbitrage, so-called, right? If I can do this outside the system, and that's where the banking system, if you look in the United States, where it's simpler to describe because of the depth of capital markets, half of every asset class, meaning commercial loans, consumer loans, or more, is outside our banking system. And so, and you're saying, is that a good thing or bad thing? You could say it's a good thing because it spreads a risk, but it's not a good thing if the activity goes on in a different regulation. So if we're allowed to do a leverage of X for a company and that looks like good credit, why can somebody just put it in a different place and do more leverage? They may be right, but then why can't we do it? You shouldn't have regulatory leakage cause a problem. That piece got lost in the banking regulation principles that Dodd-Frank came in and around the world. All these institutions came into the banking environment, were regulated by the ECB, by the PRA, et cetera, et cetera. Now they're leaking back out, and that's the question.
You are in many different countries. Outside of the US, which countries are you the most excited about?
Well, we continue to be excited about what's going on in the Middle East in terms of inward development now. In the days where people went and said, you're making money, give us your money to go manage. It's a different world and different possibilities for banking. We've been in Dubai for 60 years, so it's not like a new thing to us. But what's going on in Saudi Arabia, what's going on in the UAE, and helping those companies grow and prosper, that's kind of very interesting. Asia will always be interesting. It ebbs and flows where it's interesting. We have a great franchise in Australia, which continues to grow. We got a good business in Japan, which has a newfound of shareholder discipline and stuff, which ought to be good for investment banking capabilities. And then, in Europe, we believe that we have lots of market share to gain. It's not Europe grows at 1%, but we think with our products and services, our capabilities, whether it's in the corporate investment banking space or the market space, we just have a lot of room to grow. In the UK and Europe, I put together in that case, and all of the European sort of broader set of countries. And so we feel there's growth opportunities everywhere. And in fact, our international business, just to give you a sense of how big how much our company's changed, because our name's Bank of America, everybody thinks us as America. Our international business, we went from approximately 20 billion in outstanding loans 15 years ago to about 130, 150 billion today. So it's grown dramatically, and it's keyed us to take those multinational clients across the world and help them navigate all the economies. India's another good country. We've been there 60 plus years. We've been in these countries a long time, and we keep investing, and they're all good opportunities, especially when you have a world that's very disaggregated market share like it is in banking.
You reminded us that your name is Bank of America, and of course, this is a bit of a sensitive question, but in some parts of the world, the view of America has changed a bit lately. Do you think is Bank of America a good name to have?
It is. It stands. It's a great brand, and we do a lot of research on it. And so the great positives that come with, obviously, in a world where people want to take a position about America or say something about America, your Bank of America, people confuse us with the Fed. We're not the Fed, because in certain countries, the Bank of X is the central bank. We're not the central bank. And so you get some interesting, fun happenings around that, where people write the letter to me acting like I'm setting interest rates or something, which I'm not. But it's a great franchise, a great brand, and we have Merrill for the financial advisory business in the U.S. because it's distinctive. But outside the U.S., we basically operate as Bank of America, except where it's not legal to do that, because we do a securities business, and then we operate Bank of America, Merrill Lynch, or some other configuration. But it's a great brand, and we take its pluses and minuses. And at the end of the day, we've been around this country since George Washington was president in the oldest parts of our bank. So it's been a good ride.
Moving on to technology, how will AI transform the bank?
It's already started. So it's going to transform the bank around a couple dimensions that are different, and it's just started in earnest. First, it enables you to replace human interaction to human interaction. Second, it helps you analyze what we call text to text. In other words, big amounts of information. How do you pull them together and have them come out the other side so somebody can take that and utilize it differently? It also can help you with testing and checking things. We file literally millions and millions of reports a day, and it helps you not only prepare those, but more importantly, to test those to make sure they're accurate and helps you find out ways to improve them. So, if you back, and it helps us in computer coding, we're already using it. 18,000 plus programmers already use it and stuff. So let me give a very concrete, straightforward example. So this technique we call Erica. So Erica is the way a consumer can have a virtual assistant at Bank of America. You're hearing a lot about agent bots and all that stuff. We've had this now for 5, 7, 8 years. We started about 10, 12 years ago. And what we had them develop is we looked at the search technology, and it just wasn't going to work in financial services. So we had them develop a new natural language processing predictive model, which today we call a small language model. Back then, nobody would have called it that because it was a different world. We had them build that for us, and then we used it and trained on our own data, and it can answer questions. And now 20 million Bank of America customers use Erica each quarter, about 200 million times, to ask questions that it can answer. Now, Erica has a lot of room to go in refinements and improvements and doing it, but we know it works. And those 200 million interactions would have been a phone call, a text or an email, or walking into a branch. So 200 million times a quarter we're moving. We're heavy digitalized already. We have 50 billion consumer interactions a year. So it's a massive amount of activity. It's heavy digitalized, but the room to go to digitalize it more with AI is different than with the machine learning and other types of models we had. And Erica shows us that bridge.
And when you benchmark your usage of AI and technology against other banks, what do you see?
This is where you get into the question of what people say they're doing, what we're doing. We see Erica out there working. We don't see any product that's actually, we see certain products are just emerging that can do that. We've seen what we've done in coding, and other people are talking about it. We have 18,000 people literally doing this today. So we feel we are a company of applied technology in just massive amounts. So we spend about $4.5 billion a year on technology initiatives, we call it, which is new code and new work. We apply that relentlessly. We're one of the largest patent holders for all kinds of technology, including AI technology applications in the U.S. And so our view is we're state of the art and beyond. But what we aren't doing is announcing things which don't stick to the ribs. We're very much a company that says we'll tell people after it's already operating and drive it through the system. And so with coding, a lot of people talk about I'm doing this. What we say is let's get people going, and we're saving there's 21 steps in a project to go from business initiation to endpoint. 5 or 6 of them are capable of being enhanced by artificial intelligence. We're using it. 18,000 people. We're saving about 30% of those 5 steps, which gets about 10% overall. And so we're much more an applied driver of it. And nobody has anything like Erica in the size and scale. Nobody has the automated underwriting we do, things like that. But the real question is, how do you keep driving this to new places? And so our teammates in an investment bank are preparing pitch books. We just implemented that. They all still have people in front of them to make sure they're right and how they work, but it gives them a leg up. And so we're applying this daily customer interactions in the markets business are all driven by artificial intelligence off the base of our research, not grabbing stuff from all over everywhere and throwing together and making mistakes. It takes our research and organizes and delivers it out in a more comprehensive fashion to our clients. And so the maestro every day shoots that out to everybody. So we believe in applying this technology.
So when you have deployed all your user cases and everybody else have deployed all their user cases, and you have, the humanoid helping us on the blue collar side, what is society going to look like 10, 15 years from now?
This is one of the great questions out there, but you can talk from experience. So our company, this is my 16th year having the honor of running the place, and we've driven a lot of change. In 2010, we had 285,000 people. Today, we have 212,000 people. So that's all. The numbers of customers are larger. The numbers of interactions are through the roof. The numbers of size of the loan book is bigger. Size of the deposit book is almost threefold bigger. Numbers of consumer transactions, blah 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 blah, trading transactions, quotes, everything. Hugely bigger company, but 30% less people. That was all by applying technology. What this gives you is a chance to go to places you couldn't go before. And so what we did is we took the company and took compensation levels, AI susceptibility. The one axis compensation levels, the other axis AI susceptibility, and then dots for how big the numbers of people doing those activities are. And what you're looking for is dots that are susceptible, that are highly paid, that are big volumes of people. And that's what you're trying to go after. So that's different than the automation we went through 15 years ago. It was more processing teammates and things like that. We only have 25,000 processing teammates in the company, maybe 30,000 out of the 200-some thousand. So as the work has already shifted, this allows you to go to different places, to our risk teammates, our finance teammates, our HR teammates. The HR team uses some techniques in terms of resumes and things like that. That's the difference here. And so what's the societal impact of that? I'll give you glass half full, half empty. In 1969, America employed 80 million people worked in America. In 1960s, the advent of computers, the advent of technology, the idea that all the jobs are going to go to Japan Inc. At that point, it was before China emerged. The idea that the U.S. was going to be more abundant for employment. Today, we have 160 million people working. And so something happened as all that technology, I think from the late 60s now, came on stream. that we were able to employ twice as many people in this country. And so I think, simply put, the world has a way of working a way around us. This goes to different places. I can understand why people are a little concerned. But on the other hand, a firm like yours, which is a brain power firm, and that's what you do, it'll help people be more effective. And over time, you may be able to trim your aggregate headcount, but it doesn't mean it's going to be a long time, and maybe, someday people can fantasize about it before we have no people left.
Brian, you became CEO in 2010 after the financial crisis. What's the toughest decision you made during your tenure in the bank?
Well, the toughest decisions all ran around how we got through the aftermath of financial crisis and how we had to be so resolute on resolving issues. So we had a quarter where we settled lawsuits, the $20 billion lawsuit, et cetera. Those are tough decisions. It wasn't necessarily the financial decision, that was tough enough, but it was the people implications of deciding to take a completely different position in the mortgage business. From a company that was doing 1 in 5 mortgages, we had to go down to where we got to 5% share because what we were doing was not directly with consumers. Those were hard decisions because they affected people's lives and our ability, and had to retrain our whole brain power in the company. That was all the decisions that are toughest are about people, and disrupting other people's lives. So downsizing people, changing people. And that's why we frankly have worked very hard to do headcount management to avoid layoffs. And we've been pretty good at it for the last 10, 15 years. In the early days, we had to do some layoffs. And to me, that's the toughest decision because you're basically walking into somebody who was a great worker, worked for the company and say, you know what, we just can't use you anymore. And that's going to our AI conversations, why we're managing headcount so carefully and trying to figure out how to make sure that we aren't overstaffing and then having to take people out.
Do you tell anybody yourself, or is that delegated to other people?
Oh, I had to, I never start a process like this unless I'm willing to change the people who work for me, So actually, ironically, in the first downsizing we did after the financial crisis, I lost my job. And it was before I was CEO. I was running integration, and I decided that one of the positions they had to eliminate was mine. And I was almost out of the company, and they offered me a different job, and I stayed. So I believe resolutely that you have to start from the top. This is not a bottoms-up thing. And I also believe resolutely that management has to be careful on staffing to ensure that they don't disrupt the broad base of employees. And this is coming from a guy for 25, 30 years who spent his life doing M&A, merger integration, the relentless takeout of costs. As you went to an organic growth company, you have to be much more careful because when you're doing a merger, company A, company B, people know that there's going to be changes. When you're an organic growth company like we are now, people don't anticipate there's going to be those kinds of changes. So you have to manage in performance management, et cetera. So yes, I had to tell myself, and I would expect have all my direct reports cascade through. At those times had to take action. We basically run the company so we don't have to do that again.
You mentioned M&A, and many other banks have kind of pivoted into wealth management, fintech, acquired things. Now, Bank of America has maintained a very steady course. Why is that?
Well, there's one, I don't want to go to jail because it's illegal to acquire banks in the U.S. if you're above 10% of deposit. It's not criminally responsible, but it's just against the law, honestly. And so we cannot acquire another bank with deposit unless that bank fails. And
lots of other stuff you can buy, right? Wealth management, whatever.
Then when you go to wealth management and other stuff, a lot of it has deposits in it, and so we've been careful about that. But let me step back. In the end of the day, we have such an organic growth capability in this company. So our highest market shares are in the low, 10, 13, 14%. We got a lot of room to grow, and we have the brand capability, the teammate capability, the product capability. You can just drive the organic growth. So when people say, we got out of the asset management business because we thought it was inconsistent with being the biggest distribution house. We have $4.5 trillion in wealth management assets. We take great companies and manage money and get them into our investors. We didn't need to make the product, honestly. And so we sold that, but that doesn't mean we don't have a huge stake in wealth management. It's one of the biggest in the business. So that happens. And so we're always trying to think through our basic principles. We have 8 customer businesses. We go after the customers directly. We don't do indirect business, so we try to really focus on that. And that led us to saying, our best thing was to be giving financial advice to the customer, whether it's automatedly through Merrill Edge or personally through the private bank or Merrill, rather than basically it's a wholesaling asset management product. So as we look forward, we bought companies in payments, in payment technology. So we bought companies in medical payments and other areas, and we will continue to do that to add products and capabilities in the payments area. And we've also formed companies. So Zelle, which had a predecessor, but was formed by the industry. We formed companies to help drive that. We'll continue to do that. So, our view is we're an organic growth company, and we got to be focused here. And then if we see a market opportunity, like in the 401k business, we invested, $100 million in our business and drove it because with a, $65, $70 billion expense base, an incremental 100, 200 million, rather than doing an acquisition, if you can even find a company and figure out how to reconfigure it, you could just drive it and drive it through the sales force. So we've learned a lesson about how fast we can drive things we're willing to spend the money to support.
How would you describe the corporate culture in the bank?
The corporate culture, look, I think it's embedded in the phrase, the question we ask: what would you like the power to do? Our culture is to help serve our clients, to help them achieve their financial goals. And do that and serve all our constituencies. Our clients, our customers, help them meet their goals. Our teammates help each other meet their goals. Our shareholders help them meet their goals, and our communities. Because at the end of the day, we have to make sure our communities are strong and resilient, because that's the core base of the economy of which we make our money.
Do you think a bank is a bank? Do you think the corporate culture in your bank is very different from other banks, or is a banker a banker?
I think the products and services are more commodity. The way you deliver them is not. And so delivering on a customer-focused basis, direct to the customer, not having those places that are indirectly customer businesses, et cetera, that is different. But in our products, our brand, and our capabilities, our talent, the fact we're global, the fact we're nationwide, those are all very unique things. There's only a couple of us can do what we do on a global basis for corporates and investors around the world. There's only a handful of companies. So those are very unique. But you just said a checking account's a checking account, but how you deliver that checking account on a customer-focused, integrated rewards basis, that takes a philosophical difference. And then how do you position yourself as our client, our customers, our teammates, how they desire to help the customers put our brand at the best, just keeps going up and up and up in terms of satisfaction in all our businesses. That's unique. That focus, I think, is unique.
Okay, so now we're coming into one of your 3,700 branches, okay?
Yep.
I'm 52 years old, got a checking account. How can I feel that Bank of America is different from other banks?
Well, I'll tell you a story. I was sitting next to somebody that I didn't know, and they turned to me and they said, we went in with 3 generations of my family a day, my father, me, and my son, and we all had business. And the people did such a great job. Her father, who had been a leader in the military, said they run a pretty good unit on the way out the door, which meaning the execution was strong. So, but all the customers felt that way. She said they took great care of my father. They took great care of me. My son was excited to open his first bank account. That's what we want to instill, is that at the point of attack. That happens over and over and over again. And by the way, my emails in the public domain, if a customer doesn't get that experience, they're not fearful, right? Let me know. And so I don't, they can send an email directly to me and to our other teammates at the top of the house. So we hear about, anything goes bump in the night, and we try to figure out why and re-engineer it. That's the process side of running this huge enterprise. You leave nothing to chance. But the feeling side you want is that customer came just unsolicited, tell me, to your point, I walked in your branch and I got this experience, and that customer didn't know me. Other customers who know me will tell it, but that customer I'd never met in my life until I sat next to him at a thing that was unrelated to bank.
What do you think is the key to building a high-performance culture?
Look, at the end of the day, you got to get great people. You got to coach them. And the number one thing is they got to believe the company is in it for them. So they continue to seek development. They continue to seek advice. They continue to learn. They feel the culture not only will help them do the day-to-day, save, protect their family, keep their family healthy, that stuff. They really want to know this company's going to help me do something here I can't otherwise do. And so in areas where we're recruiting against the the biggest, best firms in the world that you can describe in technology or cybersecurity. The people come here because they know they can do special things, but they also know that we're going to do it the right way. And I think that's the key to getting that talent. You got to get that talent, but you got to make sure that talent thrives. And so we take an employee survey, and we just got back the results, and it's up it continues to increase and up a couple points since last year. But 180,000 people fill out that survey. And so it's not and we asked them, what do they think about the company? And 48 questions, and we're doing it for 30 years, and we can look at the nuances. But you want them to say, I believe my manager is going to make me better, and I believe I can do anything I can do with this company, and I can seize on that opportunity. That's what gets that culture going that you want, because that then means the best and brightest will come, stay, and prosper.
Where do you personally seek advice?
I get my advice from doing what I suggest. I read a lot from a lot of sources that I may or may not agree with. And then I always am watching what other companies do and what other CEOs do and what other CEOs in the past have done. And it's not like I go to X and say, what do you think? It's more you get a panoply of X's and say, how do you think about how they thought through these questions? So I've had the luck of having great mentors along the way, but every time I sit in a session, I'm always trying to figure out how some of my peers analyze the problem that I may not have thought to, what they're thinking about, or other companies, what they're thinking about, or listen to clients. And so it's just, you got to be a learning machine. And that's the trick about being a CEO or anybody in our society today, is the information is curated to you, and you have to avoid curation. You have to seek beyond that. You have to try to find out different things. And then in an industry where you're the leading company, one of the leading companies, you also have to look outside our industry a lot to what is important. So when we think about our brand, we're, yes, in financial services, et cetera, but what are the best brands that ever existed and why? And when did great brands make mistakes? That's where you think about, Jim Collins and the great business writers and Why the Mighty Fall and all these different things. You're always trying to figure out from all that, sort of.
What are the best brands which ever existed?
Oh, we look at them all the big consumer brands, all the big institutional brands. People have grown market share organically across periods of time. And we're studying them, and I won't name them because that's not fair to them or to the ones I wouldn't name, but you'd have your usual suspects. But you're always in different business, so you can't just say they did this, we do that. You have to sit there and say, what were the principles by which they did this?
What are the biggest reasons for failure that you are trying to avoid?
I think A, complacency. B, you get stuck in bureaucracy and progress. A large company, how do you break through that? C, you don't get ahead or get ahead of a trend. And this is where AI is kind of interesting, is we got to utilize this and drive it. But if you get too far ahead, you can bet the company in a way that may not work. And so that's and those are the source of failure. People who get too far ahead of a trend or don't keep up with the trend, or don't keep the brand fresh, or don't think they're doing well when they're not doing well, and are willing to poke it and ask questions. So while a CEO would, always has to be optimistic, in the heat of the night, you have to be very sort of, what are we doing wrong? What can we do better all the time? But you have to make sure you translate that into action, into process, so it gets done. And that's tricky, yes.
How do you remain a learning machine?
You just, I get up early in the morning and I just absorb, and just start reading, multiple papers, multiple news sources, multiple research papers, and you're just listening out there. You're always listening and trying to learn. And by the way, we talk about young kids today. One of the fears I have is the curation of the way they get fed, the way we all get fed. I shouldn't say it's young people, it's everybody. The way we all get fed through news feeds and the algorithm and stuff narrows your scope as opposed to improves your scope. But there's a book written by a fellow named Brian Grazer, who's a great movie producer, writer, etc., called A Curious Mind. I always recommend that to the young kids because they say it talks about his career. It's a fun story. He's a wonderful human being and done wonderful things. But he did it a lot by just asking questions and learning a lot. And, I always say to people, that's the way to pattern your life. I ran into that book, 10 years ago or so. But you look at that story, and that I suggest your listeners read that book. It's 275 pages, but it just keeps reminding you that if you keep trying to learn, you'll be a powerful engine. But if you stop learning, you get curated. That's the problem. So I get information from lots of sources, but the key is how do you keep making sure that aperture stays open, doesn't get closed? Because every time you look at X, Y, and Z, it starts to shove into that corner under the modern techniques for information delivery.
Well, I think that's a great place to end, because normally, guess what? We end with, advice to young people, and you already given it. Seems like you have to read that book to remain a learning machine like you have, and it's for sure very impressive what you have achieved. So big thanks for being with us today.
Thank you. Thank you for all you do, and hopefully you enjoyed it, and look forward to talking to you again.
Absolutely.